Have you felt it? That chill in the air, that nervous energy flickering across your crypto portfolio. After Bitcoin's record highs and the flood of institutional money, a new question is echoing. Is the bull run over? Are we on the edge of another crypto winter? The mood is shifting. The easy gains are gone, and the market's relentless momentum has stalled. Prices wobble, altcoins struggle, and every dip feels more permanent. So, what now? Panic and sell, or double down? The answer lies in understanding the forces at play and preparing a smart strategy. Let's break it down. What is a bear market really? The term gets thrown around a lot, especially when prices start to tumble and panic sets in. But let's break it down. A bear market is more than just a bad day or week in the markets. It's a sustained period where prices fall, optimism fades, and fear takes over. In traditional finance, a bear market is officially declared when an asset or index drops at least 20% from its recent highs. This isn't just a random dip, it's a significant, prolonged downturn that can last for months or even years. In stocks, it's a 20% drop from recent highs. This threshold is widely accepted by analysts and investors as the point where a correction becomes something more serious, a true bear market. It signals a shift in sentiment, where hope gives way to caution, and investors start to question whether the good times are over, at least for now. In crypto, that can happen in a day. The market is famously volatile, and wild swings are part of the game. But a real crypto bear market isn't just about a single crash. It's about a relentless, grinding decline that drags on, wearing down even the most enthusiastic investors. Prices can plummet quickly, but the true pain comes from the slow, steady erosion of value over time. A true crypto bear market is a long grind. Prices stay down, rallies fizzle, and sentiment turns from euphoria to fear, then apathy. The excitement that once fueled the market disappears, replaced by doubt and uncertainty. Social media, once buzzing with bullish predictions, becomes quiet or even hostile. Investors who once bragged about their gains now avoid talking about crypto altogether. It's a psychological battle as much as a financial one. The 200-day moving average is a key signal. When Bitcoin falls below it and can't recover, the bears are in control. This technical indicator is watched closely by traders and analysts alike. Staying below this line for an extended period often confirms that the market is in a bearish phase. It's not just about numbers on a chart, it's about the collective mood of the market and whether confidence can return. Think of it as winter. Growth stops, weak projects fail, and only the strongest survive. Just like in nature, a bear market is a time of hibernation and survival. Companies and projects that aren't built on solid foundations often disappear, while those with real value and strong communities endure. It's a cleansing process, painful but necessary for long-term health. Corrections are normal. Bear markets are a deeper, longer shift. A correction might last a few weeks and then recover, but a bear market can drag on, testing patience and resolve. Understanding the difference helps investors make better decisions and avoid panic selling at the worst possible time. We've seen it before, 2018, 2022, these periods test even the most committed believers. During these years, many projects vanished and prices hit rock bottom, but those who stayed informed and kept perspective often found opportunities when the market eventually recovered. History shows that bear markets, while tough, are also times of learning and growth for those who stick around. Knowing the difference is the first step to surviving. By understanding what a bear market truly is, you can prepare mentally and financially, avoid common mistakes, and position yourself for the next cycle. Remember, every winter eventually gives way to spring. And in crypto, those who endure the coldest seasons are often best positioned for the next big opportunity. How do you spot a bear market before it's obvious? First, look for a sustained drop, lower highs and lower lows, not just a flash crash. When Bitcoin and the Coin 50 index fell below their 200-day moving averages in early 2025, it was a major red flag. Next, watch for new capital drying up. Without fresh money, prices stagnate and fall. Venture funding is way down from the last cycle, and that's stalling the market engine. Finally, pay attention to sentiment. When headlines turn negative and friends ask if they should sell, the tide is turning. These signs don't guarantee a bear market, but together, they're a strong warning. Stay alert. Why do so many analysts think a downturn is near? The crypto market, once known for its wild independence, is now showing signs that have seasoned investors worried. Over the past few months, a growing chorus of experts has been sounding the alarm, pointing to a convergence of technical, economic, and psychological factors that could signal the arrival of a new crypto winter. But what exactly are they seeing, and why does it matter now more than ever? The technicals are clear. Bitcoin and most major altcoins have broken below their 200-day moving averages, a level that many traders consider a crucial line in the sand. Historically, when prices fall below this threshold, it's often a sign that momentum has shifted from bullish to bearish. This isn't just a blip on the radar, it's a classic bear signal that's hard to ignore, especially for those who've seen previous cycles play out. Altcoins are especially weak, with many down 80–90% from their highs. This kind of drawdown isn't just painful, it's a sign that risk appetite is evaporating fast. For newer investors, these sharp declines can be shocking, but for veterans, it's a familiar pattern that often marks the start of a longer, colder season in crypto. Investors are fleeing risk, moving their capital into safer assets like Bitcoin or even cash. This flight to safety is a defensive move, reflecting a lack of confidence in the broader market. When uncertainty rises, people tend to protect what they have, rather than chase risky gains. Macroeconomic headwinds are also blowing strong. Persistent inflation, ongoing global tensions, and tighter fiscal policy are creating a challenging environment for all markets, not just crypto. Central banks are raising interest rates, governments are tightening their belts, and the world is watching for signs of recession. These factors combine to create a storm that's hard for any asset class to weather. Crypto now moves with global markets more than ever before. The days when Bitcoin was seen as a hedge against traditional finance are fading. Now when stocks tumble, crypto often follows suit, showing just how interconnected the financial world has become. When stocks get shaky, so does Bitcoin. The correlation between equities and digital assets has grown, making it harder for crypto to escape the gravitational pull of global market sentiment. This means that even if crypto fundamentals look strong, external shocks can still send prices spiraling. And don't forget market cycles. After every explosive run, a correction almost always follows. This is a natural part of how markets work. Periods of euphoria are often succeeded by phases of fear and consolidation. Understanding these cycles is key to surviving and thriving in the long run. The 2024 run to $73,000 was historic, capturing headlines and drawing in waves of new investors. But history teaches us that what goes up must eventually come down. Parabolic rallies are often followed by sharp corrections, and those who ignore this lesson do so at their own peril. Some say this time is different, pointing to new technologies, institutional adoption, and changing regulations. But the bears argue that we're overdue for a reset, and that ignoring the warning signs could be costly. The debate rages on, but one thing is clear. Uncertainty is at an all-time high. Ignore the warning signs at your own risk. Whether you're a seasoned trader or a newcomer, now is the time to review your strategy, manage your risk, and prepare accordingly. Winter might be coming, and it pays to be ready. But what if the old rules don't apply anymore? Institutional adoption, especially spot Bitcoin ETFs, has changed the game. Giants like BlackRock and Fidelity now hold billions in Bitcoin, providing steady, long-term demand. This persistent buying pressure could cushion crashes and reduce volatility. For the first time, Bitcoin broke its all-time high before the halving, and the post-halving crash hasn't materialized. The halving's impact is fading as most Bitcoin is already mined. Now, demand from ETFs and macro trends matter more. Bulls argue this means longer, less volatile cycles and shallower corrections. Maybe the market is maturing, maybe the 4-year boom-bust cycle is breaking. Only time will tell. No matter your outlook, risk management is your best defense. First rule: avoid leverage. It can amplify gains, but in a downturn, it can wipe you out. Take profits systematically as prices rise. Don't let greed trap you at the top. Use stop-loss orders to protect yourself from catastrophic drops. Diversify. Don't put all your eggs in one basket, and never invest more than you can afford to lose. Have a plan. Know your loss limits, profit targets, and exit points before you invest. Stick to your plan, especially when emotions run high. In crypto, discipline is survival. Building a resilient portfolio means diversifying and staying liquid. Don't go all in on one coin. Hold blue chips like Bitcoin and Ethereum, plus a mix of promising projects in different sectors. Consider diversifying outside crypto, stocks, real estate, for added stability. Keep some cash or stablecoins on hand. In a bull market it feels wasteful, but in a bear market, cash is king. Liquidity is your safety net and your opportunity fund. When prices crash, those with cash can buy quality assets at a discount. Don't just survive the downturn, be ready to capitalize on it. Dry powder turns fear into opportunity. The most powerful tool in a bear market isn't technical, it's psychological patience. Ignore the daily noise, focus on the long-term vision. Dollar cost averaging, investing a fixed amount regularly, removes emotion and smooths out volatility. It's tough to buy when prices fall, but that's when you get the best deals. Invest in projects with real fundamentals, not hype. If you believe in crypto's future, a year-long downturn is just a blip. Bear markets burn away the weak, leaving stronger foundations for the next cycle. Stay patient, stay focused, and think long-term. A bear market isn't the end, it's a transition, and for the prepared, it's an opportunity. While many see it as a time of loss and despair, savvy investors recognize it as a chance to buy assets at a discount. The market's downturn is a natural part of the economic cycle, and those who understand this can position themselves for significant gains when the market rebounds. The biggest fortunes are made by buying during the despair, not at the top. When everyone else is selling in panic, the wise are buying. This contrarian approach has proven successful time and again. History shows that those who invest during bear markets often see the greatest returns when the market recovers. Every crypto winter has led to a bigger bull run. The cyclical nature of the cryptocurrency market means that downturns are followed by periods of rapid growth. Investors who hold or buy during these low periods are often rewarded with substantial gains when the market turns bullish again. Those who bought during the lows reaped the rewards. It's a simple yet powerful strategy. Buy low, sell high. By staying calm and making informed decisions during market downturns, investors can set themselves up for future success. Bear markets are clearance sales for the future. Just like a savvy shopper looks for deals during a sale, smart investors see bear markets as an opportunity to buy valuable assets at reduced prices. This mindset shift can make all the difference in long-term financial success. Your preparation determines if you can take advantage. Having a well-thought-out strategy and being ready to act when opportunities arise is crucial. This means doing your research, understanding market trends, and having a clear plan in place. Manage risk, stay liquid, diversify, and keep your eyes on the long term. Don't try to predict, prepare. Diversification helps spread risk, while liquidity ensures you can act quickly when opportunities arise. Focusing on the long term helps you stay grounded and avoid making impulsive decisions based on short-term market fluctuations. Build your fortress, keep cash ready, and be patient. Having cash reserves allows you to take advantage of market dips without having to sell other investments at a loss. Patience is key. Waiting for the right moment can lead to better investment decisions. If winter comes, you'll be ready to plant the seeds for the next bull run. Just as a farmer prepares the soil and plants seeds in anticipation of the next growing season, investors should be ready to invest when the market is down, setting the stage for future growth. Be prepared, be patient, and be ready to act. The market rewards those who are ready to seize opportunities when they arise. By staying informed and prepared, you can make the most of the market's cyclical nature. The next opportunity is just around the corner. Stay vigilant, keep learning, and be ready to take action when the time is right. The market cycles are inevitable, but with the right mindset and preparation, you can turn them to your advantage.